Hello and welcome to Money Chat Leaders and Laggards for 2025. From AI champs to tariff trap, I'm Nova Lui, Head of Investor Advisory at RHB Bank. Thank you for tuning in. On this show, we cut through the noise to discuss the leaders and laggards in today's equity market, crucially where we can identify opportunities to either buy quality at low valuation or lock in gains when valuation looks cheap. Joining me is Raisha Rashid, Vice President and Global Market Strategist at JP Morgan Asset Management, based in Singapore, with the Global Market Insight Strategy team. Raisha will share her thoughts on the recent rally in the Chinese equity market and Asia market as a whole. Raisha, great to have you. Raisha will share her thoughts on the recent rally in the Chinese equity market and Asia market as a whole. Raisha, great to have you.
Thanks for having me, Nova.
Raisha, China's equity market had rallied sharply in 2025, where MSCI China up by about 42% on year-to-date basis as of end of September. Where do you see any further upside from here, and what drive the upside prospect in this market?
Yeah, so I think when it comes to Chinese equities, we do see opportunities on both the onshore market as well as the offshore market, and these are for two separate reasons. So if you focus first on the onshore market, I think we've all heard about the anti-involution campaign, which is really a campaign to curb overcapacity in certain sectors. But I think one thing to note is that the sort of structural reforms that we're seeing now is not to the same degree that we saw in 2015, 2018. So we do think that investors' optimism has run a little bit ahead of what it really is. But that being said, we do think that at least going forward, there will be a shift from more structural focus to more cyclical focus. And that's in line with the fact that GDP growth in China is slated to decline, at least going into 2026. So what you're going to see is that on the fiscal policy, you are going to see fiscal bond issuance being stepped up. You're going to get a lot more liquidity injections through your triple R cuts as well as monetary policy rate cuts. So that's really going to benefit investors who are very invested at least in the onshore market. Now, the offshore market is where it gets a little bit more interesting because we've all heard about artificial intelligence, and that's very much a US-centric story. But China has really, really caught up this year as well. We have seen some of the hyperscalers in China, and the top four are expected to spend about $50 billion just this year alone. We do think that there's a lot of scope for that to really expand, and that's really going to push the frontier of AI in China as well. So again, you want to have some exposure to the offshore market to really capitalize and monetize some of these structural themes that we don't think is a 12, 18-month story, but it's really a 5, 10-year story.
With the emerging market equity up and allocation is still underway comparing to the developed market, are you seeing a durable rotation of fund flows from developed market to emerging market?
Yeah, I think just to long story short, we do think that there are opportunities outside of the developed markets. You can see in the quilt chart right in front of you, you do see that some of the EM markets have done very well, especially out here in Asia, for example, Korea. Now, part of that is the story of the US dollar being weak so far year to date. Now, the expectation going to 2026 is that the US dollar will decline about to the tune of 4 to 6%. So that's the pace of depreciation expected into 2026. And that's really important because that's going to give you that sort of returns from currency perspective as well. What's interesting, at least from an EM perspective, is that there are a lot of idiosyncratic stories that investors can take advantage of. Out here in Asia, there's obviously your demographic story in some parts of the region. So we're talking about India, Vietnam. The tech cycle is very much also an Asian story. And also corporate governance, whether we're talking about Japan or the value up program in Korea, we do think that there are plenty of opportunities out here in EM, and especially for investors who are looking to rebalance their portfolio. For example, they might be their portfolio might be a little bit more concentrated in developed markets, whether European equities or US equities. When there is a market correction, we do think that this is the time for investors to really look to diversify portfolio, and EM could be one of those opportunities for investors.
In terms of valuation, given the Asia valuation gap and the AI-linked leadership in Taiwan and Korea, do you currently overweight Asia Pac versus US, and which catalysts matter the most?
So I think for a long-term story, we still like US equities for the AI theme. So that's still maintained, at least from our perspective, to be that core allocation from an equities perspective. But what we're saying is that look, that while US is known to be the AI leader, Asia is a tech leader in many ways as well. So we're talking about semiconductors, hardware, cloud computing, softwares as well. And this tends to get overlooked, as you mentioned rightfully, that valuations are at a discount out here in Asia compared to the US. I think it's very well telegraphed the story from the mega caps in the US. We have valuations, higher than the benchmark right now. And I think the risk to that is if you get a sort of correction if earnings do not deliver, especially if capital expenditure is rising and rising year in, year out. So I did mention slightly before that you think about China, they're expected to spend $50 billion this year, the top four hyperscalers. Now, if you think about the US, that number grows from 50 to $300 billion. So the fact that China's four hyperscalers only spending 50, we do think there's a lot of scope for them to expand. We are seeing, for example, in China, AI is very embedded in online shopping, gaming, etc. If you think about Korea, they do high bandwidth memory chips. 95% of the leading edge semiconductors are done in Asia. So I do think that investors should really, really take advantage of this opportunity at the current valuation because we think at this current valuation, it does not really justify the sort of quality and the scope of how AI can really run as a structural trend out in Asia. So again, for investors who are overly concentrated in the mega cap, in the AI tech growth story, there are other opportunities to actually play that story at more favorable valuations. So while US tech equities are still the core allocation, just diversify and look elsewhere at more favorable valuation. Asia is the place.
Moving to on the US tariff, on the 10th of October, US announced an additional 100% tariff on China import, potentially effective by 1st of November, following Beijing's tighter export control on rare earth materials. From your perspective, is this primarily a high-stake negotiating gambit to extract better trade terms, or a structural shift that changed the balance of leverage in tariff talk given China's rare earth dominance? How are you positioning across equities over the next 12 to 18 months?
Yeah, so I think it's very important what you mentioned also that this announcement of the 100% tariffs is really in response to China's rare earth export regime controls that was imposed last Wednesday. So I think that's very important to note as well. So our baseline view remains that peak uncertainty around tariffs is behind us. So Liberation Day was the peak uncertainty. Going forward, we're still ironing out a couple of details, right? Whether it's the Section 232 details, etc. Investigations, they're still ongoing. Now, we do think that this is some sort of a negotiation tactic ahead of potential meeting between policymakers in US and China, where they're going to be meeting at the APEC summit at the end of October. So a lot of things can happen between now and then. But again, if you've seen in the past how countries have really kind of navigated through some of these exports controls and tariffs and how they diversify their sources. If you take soybeans, for example, that has gone down to zero between China and the US, and that's because they're finding alternative places to import soybeans from. And we do think that given the diversified global supply chain that was really in place since the 2017, 2018, the first tariff war, we do think that this is going to continue to happen where you are going to see a more diversified supply chain. So there are always going to be winners and losers. And what we tell investors is that you have to be very selective when it comes to really identifying which the winners and the losers are. Unfortunately, this whole new tariff regime is something that we think it's going to continue to stay in place, at least through the next administration. But I think that's very important to note that there's still opportunities for investors, and diversification is a way to really mitigate some of that concentration risk that you might have to a particular market.
In Malaysia unit trust market, we have experienced quite a net outflow from Asia funds for the past 2 to 3 years. Can you give a quick wrap up on your preference in Asia Pac market? For example, beyond China, is there any Asia market that you have the high conviction, or is there any specific sectors within this market that you like? That would give our investor a great boost of confidence?
Yeah, so I mean, you mentioned China already, and China is a place, like we said, you got to be very diversified across both onshore, offshore. Offshore, obviously, taking advantage of the AI trend that we've spoken quite a fair bit about. But I think for the rest of Asia, I would really bucket it into well, I'm gonna put it into two buckets, and one of it is the ASEAN, and the other one's the North Asians, which is primarily Korea and Taiwan. Now, obviously, Korea and Taiwan, seeing Korea equities really rally quite significantly in this year so far. But that being said, the structural trend of AI is still very embedded in Korea. Obviously, things like the value up program, these are long term story. You're not gonna see the fruits of that labor happen manifest itself overnight. It's almost like watching bamboo grow. It doesn't happen overnight. So being invested, whether is it in Korea or in Japan, for example, that's going to be very important. Now, in ASEAN, I think it's getting a little bit more interesting. It tend to get kind of overlooked also. For example, in a place like Malaysia, we talked about a lot of data centers, and that is still very critical to the AI ecosystem. We are seeing some of these MNCs really moving towards, Southeast Asia to really set up factories, etc. And, data centers is a very, very important input as well into the entire AI ecosystem. And then you look over to Singapore, where they are making structural reforms when it comes to the equity landscape, really trying to improve the accessibility and the offerings for equities to all investors, and not just to the typical REITs and banks. So we are getting a bigger offering now in Singapore. If you look at Vietnam, we have seen a lot of efforts on the fiscal to really step up, and to really kind of clean up the market as well. So really, if you just consider the valuations, for example, in ASEAN, they are a lot more favorable than they are in the developed market. So for investors, at least closer to home over here, who are actually looking to diversify away from their US exposure, looking towards ASEAN, again, for that long-term story, it's not, a 5-6 month story. Even a 12-18 month, you are getting rate cutting, central banks, at least in this part of the world, really cutting and preempting some of that rate cuts, front loading it, and really stepping up fiscal support, especially in this external headwind, because I do think that there is understanding that, for example, when it comes to tariffs, they are going to be in place for a long, long time. So really increasing the self-sufficiency is going to be very important, really responding from a domestic perspective, whether fiscal or monetary policy is going to be very important. And we're already seeing that, which is a very fortunate thing.
Okay, thank you very much for your sharing today, Rasha.
Thank you so much.
Our next guest is Derek Yee, Managing Director and Client Portfolio Manager, Asian Equities at Manulife, based in Hong Kong. He brings over 20 years of industry experience, including roles at Standard Chartered, Nomura, Merrill Lynch, and Franklin Templeton. He holds a Bachelor of Science in Business Administration and Management from UC Berkeley. Thank you for joining us today, Derek.
Great. Thanks for having me, Nova.
Derek, India has lagged behind the broader Asia in 2025 and now face higher US tariff on select exports. Do you think the worst is behind us now?
Well, I think the underperformance of the Indian market relative to Asia really began in the fourth quarter of last year, 2024. GDP growth for the calendar third quarter came in at 5.4%, which was well below market expectations. India's GDP growth really sharply slowed due to a contraction in government capital expenditure, while the Reserve Bank of India maintained tight monetary policy. And this caused a slowdown in credit growth. Moreover, the RBI had also focused on curbing unsecured credit growth. Now, another impact as we move into 2025 was really what you mentioned earlier, the tariff concerns. But one thing to understand is that India's total goods exports to the US is roughly 2% of GDP. In August of 2025, India goods exports to the US were subject to a 50% tariff, making it one of the highest rates amongst US trade partners. However, it is important to note that not all sectors are impacted. Those tariff-exposed sectors, such as agriculture, gems and jewelry, and textiles, really are a small share of the overall stock market. Now, when you combine slower earnings growth in India the uncertainty around U.S. policy and trade tariffs, and this coincides with a stronger U.S. dollar, higher U.S. Treasury yields, we saw that foreign portfolio investors, or FPIs, have been net sellers of India over the past year. This has resulted in FPI ownership of the India market to be at 10-year lows, and their weighting has moved from an overweight position to an underweight. So these are the causes of the broader underperformance of India relative to the Asian market so far in 2025. Now, if we see, and what we'd expect is for some of these dynamics to revert, which we believe should provide upside to the Indian markets going into the end of this year and into next year.
Eric, is the current India government's monetary and fiscal policy supportive for the long-term India's growth story, or do you think that more stimulus plan is required?
Right, that's a great question considering the environment we're in today. Now, I think when we think about the slowdown in growth where we are currently, the 50% tariff equates to about 1.2% of GDP. So that's the impact or the slowdown that you would have if the 50% tariff rate stays. But on the policy front, from the Indian government and the RBI, they've taken measures such as GST reforms, along with income tax and interest rate cuts, which has nearly offset the slowdown from that 50% tariffs. So what we're seeing today with the current policies that have been put into place to stimulate growth is really a 1.2% windfall to GDP, which nearly offsets the 1.2% detraction from tariffs. So one thing to note is that India has the policy flexibility, the fiscal strength, and the monetary headroom to cushion the near to medium term impact and support growth without compromising macro stability.
What is the current market setup in India and what are some of the things that need to happen?
Right. So currently, domestic inflows continue to remain consistent and have provided support to the market during the most recent slowdown. It is also important to note that the gap between domestic ownership of the Indian markets and the FPI ownership of the Indian markets is the widest it's ever been, with domestic ownership nearly at 20%. Additionally, the percentage of household ownership of equities is currently at 6.7%, which gives us confidence that there continues to be a long runway for domestic flows. But as mentioned earlier, FPI investors have been selling their Indian equity holdings over the past year. And as a result of this underweight positioning, the current FPI positioning with potential earnings inflections provides a positive backdrop and can provide the next leg up for Indian equity markets. So what we're looking for are for FPIs to be the incremental buyer when things do turn around.
Eric, as we are now in the interest rate cut cycle, it's perhaps timely to also talk about REITs. We noticed that listed REITs has historically outperformed after the interest rate cut cycle. Do you expect things to be different this time around?
The short answer is no, we don't expect things to be different. However, what we need to understand is that over the past 2 years, investor focus on U.S. rates and rate direction were key drivers of REIT underperformance. But when we think about the underlying fundamentals, we understand and we realize that domestic rates are a bigger driver of the recovery in terms of dividend income growth. So when we think about interest rates, not only does it provide lower interest costs and a return to distribution, but it also allows REITs to look for opportunities for inorganic growth. So as long as we continue to see lower domestic financing rates and positive operating fundamentals, we believe that there continues to be upside to the asset class.
For investors that would be considering REITs now, what are the 2 to 3 reasons that you would want to highlight for our investors? Would it be lower funding costs, improving fundamental, or valuation?
No, pretty much all of those. The lower funding costs are such an important factor for the asset classes. This will provide two avenues for growth. The first is a return of dividend income growth, and the second is the opportunity for inorganic growth. Now, we do expect operating fundamentals to remain healthy. So what we expect is that one of the key attributes for REITs, which is the predictability and consistency of income, we believe that has returned.
Thank you for sharing today, Derek.
Great. Thank you for having me, Nova.
Now moving closer to home, let's bring in Malaysia lens and get David Wong's view on local markets prospects. David Wong is a portfolio manager at IHAM Asset Management with 6 years prior research experience across CAF Investment Bank, UOB Asset Management, Manulife Investment Management, covering banks, consumer, oil and gas, and manufacturing. He holds an honor degree in mechanical engineering from National University of Singapore. Thank you for joining us today, David.
Hi, thanks for your time itself.
David, Malaysia's FBM KLCI is roughly flat with year-to-date about 0.3%. What are the main drivers for its underperformance versus the regional peers, and what could change that?
Sure. That's a very good question. If you look at the global equities market as a whole, the main driver this year is really the artificial intelligence, the AI thematic. So that, of course, have driven the US market, and in Asia, I think you have seen markets like Taiwan, South Korea, Japan, and to a certain extent, even China, riding on that AI wave. But if you come back and look at our domestic equities market, if you look at our FBM KLCI index, we do lack such names that have a direct exposure to this thematic. Yes, you can argue that we have names, for example, Gamuda and YTL Group, that do benefit from the thematic, but it's really just a handful of stocks that is in the entire index, and they are not exactly pure play in the sense that Gamuda and the YTL Group do have businesses that are outside the AI and data center business. So that's one. The second one also is actually that we do not also have direct technology exposure in the index. The last round we had technology name was Inari, and that was back 2 years ago, and since then it has dropped off. Hence, if you are a global investor and you would like, and if you are very hot about the AI thematic, honestly, Malaysia would be one of the last markets that you would want to look into. But having that said, also, we think that the Malaysian equities market is at an inflection point, because I think if you talk to global investors, they do really recognize that Malaysia's economic fundamentals continue to be sound. The fiscal consolidation narrative is playing out quite well, and politically, we have had no noises since the unity government took over. And lastly, also the ringgit is on a strengthening bias, so that will help foreign investors' sentiment. So, going forward into next year, we believe that there will be some form of rotation back into Malaysia when these Asia-focused funds start to rotate out from the outperforming markets.
Yeah, David, as you mentioned, there could be potential for foreign fund flow back to Malaysia. In fact, we have seen that the local Malaysia market has seen some support in the month of August, September, and early October and Feb. But is it primarily a cheapening reversion for the Malaysia market, or is there a real catalyst, example, data center, semicon, or property initiative that's starting to take hold?
Sure. I think you have rightly pointed out that some of the mean reversion play is coming back, and we think that will continue into next year. And the thematics that you have mentioned, the DC thematic, your sentiment behind semiconductors and property initiatives, they have been played out from 2024 to the better part of this year. So what are the catalysts that are driving the Malaysian equities market next year? We think that it will be a very different thematic from those that we have seen. And the key one, the key one is mainly, firstly, it's on construction, because we believe that going forward in the next 2 years for Malaysia, there will be a refocus back into basic infrastructure spending. So we could see projects such as MRT3 being announced, as well as ongoing projects that have been announced, such as Penang LRT. There will be contract and packages that will be awarded in the near future. And if you look at budget 2026, there is a lot of focus surrounding development infrastructure for Sabah and Sarawak. Hence, those construction names that have an exposure to these vulnerable states, they will stand to benefit in the next 2 years. So that's on construction. The other thematic that I think global investors have overlooked but will start to look closely will be on the palm oil angle. Because if you look at the CPO price, it has actually remained quite strong in the last year or so. And going forward into next year, Indonesia has already announced that they will be going into they will be implementing a higher blending mix for biodiesel, and there is and when that happens, and coupled with limited supply of crude palm oil in the industry, since in the last decade or so, there have been the planting activity has been slowing down. We think that in the near term, there will be a situation whereby the industry goes into a structural shortage for CPO, and that is when your global investors will start to realize that and start to appreciate the plantation sector more.
What about coming to investing style in the next 12 to 18 months in Malaysia? Which investing style that best for our investor? Example like large cap, small cap, or dividend strategies.
Sure. Okay. If you look at where we are in terms of the interest rate cycle, the interest rate environment is downward biased. And if you look at when the last time it has happened, which is in 2010 to 2018, the style that has really outperformed in Malaysia are the small cap cyclicals and your dividend yielders. Because a lower interest rate do benefit these segments of the equities market. But having that said, I think what could really derail especially your small mid cap space is really the noises around tariff. So the caveat is, if you have a negative news flow surrounding tariffs, that like we have seen last Friday, so that could bring a lot of volatility to these investing styles.
Can you do some quick recap of the key sectors that you like within the Malaysia equity market?
Sure. So we have spoken a lot about construction just now, and also plantation. And I think coming back, the technology sector is one that we think investors should really look at closely. But having that said, I think the focus should really be on those names that do benefit from the ongoing artificial intelligence thematic.
US Fed had just cut an interest rate recently, and market expect another 2 times interest rate cut. While for next year, in fact, investors expect potential interest rate cut up to 50 basis points. However, we notice that Malaysia is a little bit behind the curve when it comes to interest rate cut. What's your house view on Malaysia interest rate direction, and would the monetary policy be supportive for our equity market?
Sure. We think that in the medium term, Malaysia's interest rate should be held at where it is now. And this is where the OPR is at 2.75%. If you look at Bank Negara's focus, they have always been they have been very focused on inflation targeting. And where we are at now, in terms of inflation, we are comfortable at the slightly north of the 1% level. And why inflation has been so benign is because your ringgit strength has actually helped a lot in terms of key import prices, as well as the government's reluctance to remove the subsidy on the RON 95. So we do actually have room to bring OPR down, but because of the downward bias of the US interest rates. But having that said, I think Bank Negara will only save this room and will only cut if they see substantial risks to our domestic economy, which we are not seeing now. So I think in the near future, we expect Bank Negara to just hold pat on the OPR rate. And this will be conducive not just for your equities market, but for the financial market in general. So be it hard assets, equities, or even fixed income.
Thank you, David. That's the wrap for our money chat today. A big thank you to our guests, Baisha Rashid from JP Morgan, Derek Yee from Manulife, and David Wong from AHAM. I'm Nova Lui, Head of Investor Advisory at RHB Premier. If today's discussion sparked ideas, whether it's adding on equity market weakness or trimming into strength, please speak with your RHB relationship manager. We will help you match the right strategies for your goal, risk profile, and investment timeline. Thank you and see you again in the next Money Chat series.